All right, so we start chapter 4, part 2, use of differential analysis for production decisions. So we're going to look at make or buy decisions. We're going to look at whether or not to add or drop a product line or close a business unit. And that's about it. So we're almost done. Oh, product choice. Did I not mention that? Yeah, product choice. So sorry about that. All right, so make or buy decision is a decision on whether or not to make a product internally or buy it from a third party. Add or drop a segment means that you're going to drop either a product line or close a business unit, either add or drop. Product choice, what mix of products or services is the company going to offer? So again, here you're using differential costs when you're doing this make or buy decision. So here we have this company, same company, but apparently they've grown quite a bit. They're now producing 100,000 units, developing photos. And they have, of course, direct material costs, direct labor costs, and variable manufacturing overhead in producing these or developing these photos. So there's the cost of those things, direct labor, pretty labor intensive, this developing business. Fixed manufacturing overhead 4,000, and then they have some common costs. Those common costs are related to the fact that they're doing other stuff. Now, the direct fixed cost is the cost of leasing or a machine to process the prints. And so here, fixed costs are not always irrelevant to a make or buy decision, because if you can eliminate certain fixed costs, they have to be considered because they're going to be a differential cost. And so here in this situation, it gives us this fact that the direct fixed cost is the cost of leasing the machine that's used to process the prints. And so what they're looking at is determining whether or not to do it in-house or to simply farm it out to another company to develop these prints. And so they can eliminate the fixed costs for this machine for levels of production ranging from 1 to 200,000 units. And then the other differential costs are of course, the materials, labor, and variable overhead. Now note that the full cost of processing a print is 34 cents, which is, let's see here, all $34,000 of costs shown here. The other piece of the puzzle is that UDevelop has received an offer from the outside developer or an outside developer to process any desired volume of prints for 25 cents each. So it's costing them 34 cents each, and this outside company wants to develop any volume of prints for 25 cents each. Looks like a deal, right? We should accept this. Not so fast. This is why we use differential costing. We have to dig deeper. And so here the accounting department prepared cost analyses. UDevelop's getting fancy. They have an accounting department. So they prepared a cost analysis at both volume levels of 50,000 prints and also 100,000 prints per year. So the status quo, based upon 100,000 units printed internally, is the 34,000. Note that the differential costs, well, the differential revenue is the fact that, well, these are all costs. The fact that direct materials, they're just putting the whole cost of what this company would charge to print 100,000 units in direct materials. Okay, fine. And so the difference is 20,000 higher. And of course, labor, variable overhead, and fixed overhead, since we get to get rid of the machine that we're leasing, makes this $19,000 lower. So, and then there's the common costs. And it tells us in note B that these common costs remain unchanged for these volumes. Because they did not change, they could be omitted from this analysis. It doesn't change our analysis. It's zero difference. So the status quo versus the alternative is actually $1,000 higher. So we should reject this offer to have prints done by a third party. But note here, our decision is sensitive to the amount of production. At 100,000, it's cheaper for us to do it ourselves. But note, at 50,000 units, it's cheaper to farm it out to this third party. And so at 50,000 units, Um, while direct materials is a difference of $10,000 higher, um, it's offset by eliminating the the labor costs, the overhead, and the fixed overhead, or the variable overhead and the fixed overhead. And so in this case, the cost of farming it out would be $1,500 lower. So at 50,000 units produced, you would farm it out to the third party. Now, so what the bottom line is, at some point you would be indifferent to doing it inside or outside the company, and so that would be kind of a break-even point. And so I think the break-even point that they talk about is actually there on page, well, at the bottom of page 28, 128 and top of 129. And so that point is 80,000 prints. At 80,000, well, at more than 80,000 prints, you would want to make it yourself. At below 80,000 prints, you would want to farm it out. So they've got some decisions to make here. Now, when you're making this decision whether or not to make or buy, you also have to consider opportunity costs of making the product. What other things could you be doing with your facilities, your labor, that might bring a higher profit to you? And so here, there, back to the example, U develops expected volume is 100,000 prints. Assume that the facilities used to process prints could be used to offer a new service that would provide a $2,000 incremental contribution. Should they accept or reject the alternative to farm out their printing so that they can use their facilities and their time, their labor, for this new service that would provide a $2,000 incremental contribution? And so here you have to consider that effect. And so differential costs decrease by $1,000 if we farm out our printing to this third party and use our time and our space to do this, whatever this other thing is that they're going to pursue. So let's talk about decision to add or drop a product or close a business unit. So here the question is, they've got three things they're doing here now. They're doing prints. Apparently they're selling cameras? Yeah, they sell film processing, prints, cameras, and they sell frames. And so the owner is deciding whether to drop processing, printing, because of the volume of print sales have declined. And so here's the financial statements for the fourth quarter. So it shows operating profit for two of the lines, but prints is operating at a loss of $500. Well, do we want to do this? That is the question. So we go to our differential analysis. We look at what happens if we drop this product line versus if we don't drop the line. If we drop the line, there will be a decrease of $10,000 sales revenue. But there will be a drop in the cost of sales. And so as a result of this decision to drop, possible decision, the alternative to drop, our contribution margin to, our overall contribution margin would decrease by $2,000. Then we look at any differential fixed costs. Rent would not change. We would be able to do away with apparently maybe one employee, salaries that are related to prints, $1,000. And then marketing and administrative costs would be saving $250. So there in fixed costs, you would be saving $1,250. So the decrease in operating profit would be the difference between your loss of $2,000 in contribution margin to the overall contribution margin, less salaries and marketing administrative fixed costs that could be avoided. So your operating profit actually loses or decreases by $750. So not good. You would keep the prints. Why? Because it contributes more to your contribution margin by $2,000 than you would save costs. Those being those fixed differential fixed costs. Now, what if cost of sales, which are all variable costs, were 9,500? Thus, you would only be decreasing contribution margin by 500. Well, there your decrease in contribution margin is such that it doesn't cover, or it's less than what you would lose. And when I say lose, I mean this in a good way, that you would save in getting rid of those those differential fixed costs, which are 1,250. So in that case, you would definitely want to eliminate prints. Let's see, product choice decisions. Oh, before we get to that, back to add or drop decisions. Again, there could be non-financial considerations of closing a business unit. And this includes like a product line that is manufactured in one place exclusively. And that is the fact that if you close a facility, for instance, a manufacturing facility, you've got to consider the costs of human lives and the costs of disrupting a community. And so the example they give is General Motors and phasing out the Oldsmobile brand in Lansing, Michigan. Thousands of job cuts. I actually lived in Lansing for a little bit, and back when I lived there, it was pretty thriving because the plant was open. But I'm sure I have not been back since. But I'll just take it at face value that thousands of jobs were affected, and probably lives have been affected by this. So those are some non-financial considerations that companies have to look at when they're determining whether or not to drop a line or close a business unit. Product choice decisions. So here you have to consider constraints that you might have. Constraints are activities, resources, or policies that limit the attainment of a company's objectives. And so where companies have constraints, what they have to consider is the contribution margin per unit of this scarce resource. Well, what's a scarce resource? It's a particular input with limited availability. And in the example they use here, they have a framing machine that you could either make metal frames or wood frames. Now, the metal frames go for $50 each. Wood frames go for $80 each, price-wise. It costs more to make the frames, wood frames, than it does metal frames, so contribution margin per unit is exactly the same. So at least on its face, you would say, well, I'm indifferent to whether or not I make wood or metal frames. But that would be the wrong way of looking at this. Here you wouldn't want to look at the contribution margin per unit of product. Here you want to look at the contribution margin per machine hour. And so in your analysis here, it takes a half hour to make one frame. Therefore, you can make two frames with metal frames in an hour. Whereas with wood frames, you can only make one wood frame in an hour. Thus, when you take in consideration the machine hours required, you're actually making two metal frames for every wood frame. Thus, metal frames contribute $60 to the contribution margin when you consider your per machine hour production, whereas wood frames only add $30 to contribution margin when considering what you can make per machine hour. And thus, this is what you get. You could produce 400 metal frames, 2 per hour at 200 hours versus 200 wooden frames. Now, if you produce only metal frames, they can have an operating profit of $7,500 versus wooden frames solely, their operating profit would be $1,500. Now, that's the analysis. The question is, are we going to produce all metal frames? Well, no, you probably want to produce some wood frames also, because not everybody wants metal frames. Some people like wooden frames. So might you produce less than 400 capacity metal frames? Yeah, you probably would. You probably want to produce, let's say, 300 metal frames and then produce however many wood frames you could with the rest of your capacity, so that you have a good mix there. And then you could adjust your production based upon demand in the future. All right, so that's it for chapter 4. My throat really hurts, but I made it through. The lozenge I had in my mouth, hopefully you didn't hear, but you probably did. It didn't help. So, all right, that's chapter 4.